Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In this episode of Exposed by Math, we're going to cover the basics of trading expectancy. And basically, all that means is what are your probability of making money versus losing money. There's two components to it. You got to look at the chances of winning, and then you got to look at the size of winning and losing. So that's what we're going to cover here. Exposed by Math are generally longer videos. These are not going to be 2 or 3 minutes long. They're a little bit longer. Sometimes I go into explaining the theory. Sometimes I show you some math. So they're a little bit longer. I'm not here to sell you anything. Just trying to help you learn and really think through these concepts yourself. So let's get on to it. What is it? Basically, when you're trading, you need to know what are your percentages of winning trades versus losing trades. That's the first thing. So each trader has a different odds of winning and losing. And then the other component you need to know is for each winning, what are your average gains? And for each loss, what is your average losses? If you do that over a large data set, you can get a fairly good answer whether or not your trading method is making you money or losing you money. And then on top of that, there's really the last piece is, like when I think about stock trading, are you really beating the average, which is like, let's say the S&P 500, or not? Because if you're not beating the average, sometimes you have to look at it. You may have a positive expectancy, but all the efforts that you do, if it's not outperforming an index fund, then sometimes you need to reevaluate why you're doing it. If you're doing it as a hobby, that's fine. But if you want to make more money with very little work or no work at all, index funds are probably better. So before we get on to trading expectancy, let's start with a simple concept. If I was to ask you to flip a coin, and what are your odds of getting, let's say, 2 heads in a row, and then 5 heads in a row, and then maybe 10 heads in a row? Right? The odds get smaller each time I ask that. What if I did it a different way? What if I asked you, we're going to flip a coin 10 times and you call, is it heads or tails? And let's say you got it right 80% of the time. 8 out of 10 flips, you guess heads or tail correctly. So it's easy to think that you have a system down where you're 80% correct on a coin flip. And if I ask you, well, what are the odds then of heads or tails? And we understand this because you're like, well, it's a 50-50 chance, even if you're 80% right. And what's the first component then? The first component is really the size of the sample. If you start with 10 coin flips and you guessed it, sure, you can be at over a 50% guessing and have that number. As you do more coin flips, your guessing becomes less and less accurate over time. And most people will even suggest you will be somewhere between, right, 48 and 52%. I mean, it's sure there's some luck and but most of the time, if you're guessing heads, tail, heads, tail, heads, tail, tail, heads, the more coin flips you do, eventually you get closer and closer to 50%. In stock market, it's very similar. If you're only looking at 10 trades, it's very easy just to think that you got a system that always makes money. You do that trade more and more often, you learn a little bit more about your methods or your trading strategy. And that's what I want to talk about today. So I want to talk about the Monte Carlo or the gambler's fallacy. Why is this important? Just like the coin flip or the situation where you were able to predict 8 coin flips out of 10, you have an 80% accuracy rate. And so it's very easy for someone to just pretend, hey, I have a system down and I know the odds and I can predict it and I'm 70 or 80% correct. And this is one problem with the stock market. We actually do something very similar with the stock market saying, hey, I think I'm smart enough to predict the next move. And after you win a few times or after your prediction is right, we often think we got a system down that makes us money. And we know it's not true. This is why it's so important to really examine and understand the math. And that's what we're going to cover today. A lot of times it is a beginner's mistake. Most people who've been trading quite a bit or long periods of time, like I said, I look at my data and I realize I use index funds for a majority of my portfolio. While I still like to pick stocks, I also recognize that 70 or 80% of the time, I can probably make more money just indexing, and I play with a smaller portfolio for fun. It removes all the stress, all the work from everything else that I do. With trading, there are many different ways to play, especially in options or Forex and things like that. You can decide what risk reward you want to play. Are you going for 30% win rate, 50 or 80% win rate, or 95% win rate? And really, none of that really matters unless you look at the size of winnings versus the size of losing. And we're going to cover that next. And here's a simple formula. You can do the win rate times the average win size minus the loss percentage times the average loss size. And what you want to do is try to compute it. And here's a situation where, let's use like an iron condor as an example. You can win 90% of the time and make, let's say, $10. And if you lose that one time and you lose, the losing is 10%, but you can lose $90. If you do the math, it's 0.9 times $10, which is $9. And then you can do the 0.1 times $90, which is $9, which equals 0. So over a long period of time, you'll break even. Now, we also understand that in trading, generally speaking, if there's fees, sometimes there's drag, sometimes there's the bid-ask spread difference. And so there are ways where there's drag on your portfolio and your trading that it can actually make even this type of strategy a losing one. Here's another scenario. If you win 70% of the time and you make on average $150 per trade every time you win, and you only lose 30% of the time, but you lose $400. Here's the math. It's about $105 on the winning side. On the losing side is $120. And what happens there? If you do the math over time, you're really losing $15 per trade on average. And then when you average it out, that's what it's going to be like. And here's a scenario as the opposite. I'm using a scenario where, let's say you're doing a long call and you're betting. You take a little bit smaller. You don't need a lot of capital, but you can make a bigger return. So here I'm assuming you're using a 30% win rate. You lose 70% of the time, but you make $350 for the average win. And when you lose, it's about $100. You do the math. Over time, you're going to make $35 per trade. And this is how you can figure out whether or not you have a winning or losing strategy. In trading, there's always a trade-off. There are many ways to play options. You can do a low risk, low reward strategy, or you can do something a higher risk, more rewards. And again, the trade-off is generally pretty easy to determine. The low risk ones, you can win more often, you lose less. Low risk, maybe you get it 30 or 40%, you get it right, but you make more money. And also, you see that trade-off when it comes to like the deltas and the premiums. You'll see this on both sides. Whether you're buying or selling an option, you will notice that if you play a low delta, it doesn't cost you a lot of premium. You don't get a lot of premium. In other cases, if you're playing a delta of, let's say, 0.40 or 0.50, maybe you want to use a strategy that's at the money or near the money. Because of the delta, you're going to either pay more premium or you're going to get more premium, whether you're buying or selling. And again, depending on which way you're playing it, that's the risk reward. There's always a trade-off, and that's how the math works. So whether you go to one extreme and you go deep in the money, at the money, or far out of the money, there's always that trade-off. And in each scenario, there's no one right answer to tell you which one will make you the most money. It all depends on what happened to the underlying. If the stock pops up and it moves super fast in one direction, then obviously you can make a lot of money on a long call. The next thing is, if you go for big rewards, there are many people who can make 2x, 5x, 10x a trade, right? You put up $100 and there are people who get 200, 500 or 1,000 bucks back, but they don't do that on every trade. In fact, they do it in less than 30 or 40% of their trades are that way because there is a loss. But that doesn't mean it's a bad strategy. You have to do the math and see what the expectancy is and see if you're going to make money. Now, that type of trade does require a little bit more skill. It requires some type of ability to read charts, maybe have a better system, maybe have a stop loss strategy, maybe you're using leverage and margin, maybe you're hedging, maybe you're combining 2 or 3 different strategies together. So there are different ways, and there's no easy way to cover all the scenarios. But generally speaking, it requires a little bit more skill versus the opposite strategy. If you do something with less rewards and less risk, you don't need to charts, you don't need to follow candlesticks, RSI, IVs, trends, or even the news. Some people play leaps for that reason. They want to go a year out. They don't want to do short term. They don't want to do 0 days, 7 days, 45 days. They just want to play 90 days out, super safe deltas. You don't need to know anything. You don't have to read charts. You don't have to. Managing it's easy. You don't have to manage it once a day or once a week, right? A lot of it is a trade-off. If you go super far out, you can manage it once every 2 or 3 months if you're playing a leap. If you're doing let's say a 45-day options strategy to expiration, maybe, right, if you're selling, like I like doing iron condors 45, 50 days out, you can manage it once a week. And what I do is I'm not even really managing it. I'm just rolling the untested side for a little bit more premium. But if you use a shorter strategy, a 7-day strategy, and if one day the stock market moves 2 or 3% against you, you need to manage it. You don't want to wait till the 6th or 7th day when it's expiring, right? There's always this trade-off. Are all methods the same if they have the same expectancy? And obviously the answer is no. And there are many reasons why, right? There's different duration strategies, whether you're using a Jim Olsen Ironfly or zero DTE strategy. That's different from a typical 45-day to a 21-day and you close it for 50% profit, right? Duration matters. I mean, your strategy matters. How you manage the risk is different. And also different on whether you're playing an index or a single stock, right? There's different volatility and each one is moved by something different. Single stock is obviously news related, earnings related, merger related, CEOs gets fired. Things like that will impact the single stock a lot more. An index, a little bit less likely, but index trading still get impacted by if there was a war or there was some type of major event that caused all stocks to drop up. I mean, all stocks to go down or all the stocks to rise up. So those are different things to think about regarding, there's different ways to play. So there are different factors to consider. While your expectancy can be the same, or let's say your profit or the win rate ratio, or even, right, if you work out the math, it could be very similar, but it doesn't mean the strategies they're exactly the same, and each person still has a slightly different preference for what they want. And of course, you can figure out some strategies are more profitable than others, but again, it comes with different trade-offs. You can do a more profitable strategy, but it's harder to manage or harder to do. You can do a really boring passive strategy where you don't really do much. Most likely you're going to make a little bit less, but it's a lot easier to manage, a lot easier to maintain, and that's really the trade-off. There's always a trade-off. Nothing is free. There's no magic solution in life. So here's the summary of what I believe. I believe that each trader is different and that you have to pick a strategy that works for you and that you understand it. And then trade it. Remember, you can trade it for 2 or 3 years and still think it's working, and then it only takes 1 or 2 events, and then you realize you blow your account. And whenever you hear people blowing their account, then obviously it means what? That the trading method, it's really not good. Because if you can lose everything you gain, then there's something wrong with your trading strategy, right? If it nets out to losing money, that means you really have a negative expectancy and that you're losing money over time. It's just that you didn't recognize it or see it. And in this video, I didn't cover it, but there are many ways to improve your trading. One way is pretty obvious. If it's easy to make money on a trade, what's a little bit harder to do is how do you reduce your losses? Once you have a losing trade, how do you manage that trade better? How do you exit out, or how do you change the profile of the risk for that particular trade to reduce some of the loss? And that's a little bit harder thing to do. Sometimes we're just waiting for the trade to turn around. And those sometimes really come back to bite you in the butt, because not only does it not turn around, it plays out the way you expect and you take this really big loss. And for me, I do several different trades. I don't just do one type of trade. And I'm sure each trade has a different expectancy. But overall, when I look at my portfolio and I look at my trading, I generally trade over 1,000 options trades per year. And I'm not talking about option contracts, because there are sometimes I do a trade with 4 or 5 contracts in a single trade. And whenever I'm doing an iron condor, I really only count that as a single trade. I don't count the put spread and the credit spread as 2 trades. If I'm rolling, I don't consider that 2 trades. I consider that a single trade. Now, if I'm opening an iron condor today and then 30 days later I'm closing it, I count that as 2 trades. You're opening and you're closing. But if I'm rolling, I don't count that as 2 trades. I count that as a single trade, right? Because in theory, you're closing a losing position or a position that you don't like, and then you're opening a new one to readjust it. But I count that as a single trade. And I still average over 1,000 option trades a year. I don't count contracts. I have no idea how many contracts I do. I'm sure it's in the thousands or way more than that. I'm starting to average 4 or 5 contracts for many of my trades now. I'm trying to keep it small still. I haven't gotten up to 15 or 20 or 30 contracts yet. And for me, most of my trades are between 2 and 5 contracts. And I want to make sure I trade small still. Even though I have a lot of trades under my belt, there are times where I trade 10 contracts. There are times I trade 11 or 12. I really haven't gone above that. I want to make sure I can manage my risk. I want to make sure with absolute certainty, or at least with a 95% certainty, that my trades are going to still make me money. And on average, I have tracked my data. I do lose money about 1 month out of the year. And when you look at it from a weekly standpoint, I wish I can say I had a better weekly trading record, but I don't. On average, it's about 42 weeks where I will make money, and then about 10 weeks a year I will lose money. And this year in 2021, I think I have already experienced 6 weeks of losses already, and July was my first month where I lost money this year. So I have to make sure I tighten it up, make sure I'm not forgetting some simple things. I got to the point where my trading, I was doing so much contracts. I was doing SPY Monday, Wednesday, Fridays, and I was doing so much that I actually lost track, and for some stuff I just didn't see it, and I didn't manage my position really well. I had too much stuff happening, and for some of those SPYs, I lost money on them. I took a big loss. I probably lost 5x or 6x of the premium I collected, which is really bad. And so these are the things that you have to look at your trading history to see, can you improve on it. But in the end, I look at it over year, I make money every year. Quarter over quarter, I make money every quarter. I'm not to the point where I can say I make money every month, because there are months where I lose money. I'm not to the point where I can say every week I make money. But I'm changing my strategy because I don't know if I have the time to manage positions as much as I want to. And I really do. I use really anywhere between 40 and 60 days out when I'm opening positions. The only time I don't do that is when I'm doing cover calls. I push those out a month or so. Sometimes I push it out a week or 2, depending on how I'm playing it. There are times I'm still playing 2 free days cover calls, or maybe cash secure puts that I play that way. So I do blend all my strategies together, and each one is slightly different. Sometimes I take a profit from one trade to pay for the other trades and things like that. So it reduces my ROI, or my percentage gain. I don't chase percentages. The only thing I do is I just want to make sure I can make money overall each week and each month and each year, and that's what I look at. So with that being said, hey, drop me a comment below. Let me know, does this make sense? Let me know, have you experienced this, or if this helped you. I know I've been doing this for a while. I talk to other traders. Some people still think they're super trader. They always think they can make 30-40% a month or whatever it is. And if that was true, a lot of these people would be billionaires, and it's just not. There's a lot of people who talk big, say they're so good, and I haven't seen a lot of billionaires from trading. I just don't. Most people who do make money follow a very simple system, and it works. And there are a lot of traders who make money, but what it also means is there are a lot of people losing money. I still believe it's a zero-sum game. I still believe it's a wealth transfer device. So all the losing traders are moving money from your account into my account. And there's a lot of traders who feel that. This is not magic internet money. Somebody's losing money on the other side of the trade. And if there's a 20% population of all the good traders who are making money, it implies that there's a lot of people losing money. Anyway, that's my thoughts. Again, comment below. Let me know what you think. This is data-driven, math-based. Don't let your emotions get involved in it. You got to always understand what you're doing when you're trading. And when you do that, I believe you will have a slight edge that will help you make money. Let's do this together. Let's do this $1 at a time. As always, have a profitable day.